Hello everyone, Doug Tabor here with your rental market update for Tulsa, Oklahoma, May 2025. Let's start with the basics. Tulsa calls itself the oil capital of the world. Now, in fact, when you visit Tulsa, you must go see the Golden Driller statue. It's a local monument to the field of oil drilling. And I will say, I was mightily impressed. This statue is about 50 feet tall and it's painted completely gold. And boy, if that thing was solid gold, they're rich there in Tulsa. And while the rigs are quieter these days, certainly the economy is not. Tulsa's population sits just over 1 million. It's not sprawling like San Diego or Los Angeles, but big enough to offer steady demand and small enough to really navigate and get around the place and have an understanding for it. Let's talk about one of my favorite topics, employment. The unemployment rate in Tulsa is 3.1%. That's a tight labor market. Basically, it means people are working, businesses are hiring, and boy, the economy is humming. I was able to find over 14,000 job postings on Indeed, with more than 4,000 above the median income of about $68,000 a year. That's a strong talent pool feeding demand for rentals. Job growth in Tulsa is about 7.9%, and it's driven by a mix of healthcare, education, aerospace, and energy jobs. Top employers include the St. Francis Health System, Tulsa Public Schools, the Quick Trip Corporation, which you might know as convenience stores. American Airlines has a base there. One OK and the Williams companies, which are key players in the energy field, and big aerospace companies. Let's talk about the rental market. Average rent in Tulsa is $1,350, and that's up 4% year over year. That's a big deal. You know, we've been talking about a lot of these markets and how the rents have been either flat or in the 1 or 2%. But for Tulsa to be up 4% year over year is a big deal. Another aspect of it is it's still 20 to 35% below the national average. So you have rents that are climbing, but it's still very inexpensive to live in Tulsa from a renter's perspective. So that's a good thing, especially when you keep in mind that low unemployment rate and all those job opportunities. Occupancy rates are above 94%. So basically we have about a 5% vacancy factor. 5% is what banks like to see in order to lend. This affordability gap is a magnet for out-of-state capital and an opportunity for reposition plays. Again, that's supply and demand. You've got low vacancy, you've low rents, and you have a high demand with all of those employment opportunities. Let's talk about the single-family market. The median home value in Tulsa is just $241,000. Now, those are prices that are up 5.2% year over year. So if you're looking for a nice 322 for under $250,000, you can find it in Tulsa. Homes in Tulsa stay on the market for about 48 days. We would essentially call that a balanced market. Not necessarily a buyer's market, not necessarily a seller's market. Currently, there are about 1,900 listings, which is 16% year over year increase. So properties are coming on the market in Tulsa, which means there might be a lot of supply, which gives you an opportunity to get a good deal. I was able to look up housing starts, and we found about 1,061 new builds underway. So they're still building in Tulsa. Let's talk about my market, the multifamily market. The median price per unit in Tulsa is around $75,000 per unit. Now, if you're coming out of San Diego where it's $475,000 a unit, you're going to think, Matt, that's mighty low. I should go buy a bunch of units in Tulsa. Well, put on the brakes. Every market is subjective. They are still very hyper-local. So just because you can get that low price per unit doesn't mean it's going to cash flow. Again, you always have to have that expert on the ground, and we're big fans of that here at the Rental Market Update. Hey, it's Doug Tabor, CCIM, multifamily broker and host of the Rental Market Update. If you're like many of my clients who've owned rental properties and apartment buildings for 5, 10, 15, 20 years, you're most likely tired. Maybe you're tired of the tenants. Maybe you're tired of the telephone calls, the toilets, the turnover, the terrible teas. We've heard it many times before. And what you're looking for is maybe a little more time off, a little more travel, a little more tranquility. That's why we've created the new webinar, Mastering the Exit. Sell your rentals, defer your taxes, and reinvest into passive income streams. Spend 60 minutes with us as we cover going into a 1031 exchange and looking into more passive options. Bill Exeter from Exeter 1031 Exchange Services will do an incredible job of unraveling the mystery of the 1031 exchange. And then we'll talk about what your reinvestment options could look like. Maybe you're going into more apartment buildings in another market. Maybe you're looking to reinvest into a net lease asset, or you're interested in a Delaware Statutory Trust or DST. Or maybe you have a favorite charity and you want to learn more about the Charitable Remainder Trust. Take the hour, register for this free webinar, and learn more about what your options are so you can get away from the terrible T's and focus more on the terrific T's. I'm Doug Tabor. We look forward to seeing you there. I was able to find 26 multifamily properties listed, and the median days on market was quite high at 119 days. Certainly a buyer's market dynamic. Now, we're seeing that across all markets, including my home market of San Diego. It's just in the multifamily spectrum, it's just been a high days on market. Things aren't moving. Let's talk operating cost. I did find that property taxes were higher than the national average at 1.35%. I also found that insurance was quite a bit higher, 133% above the national average, and we all know that's due to storm risk. A lot of tornadoes blow through Tulsa. The good news, especially for multifamily landlords, is that water costs are slightly below the national average. Certainly good news for our San Diego owners who are looking for lower water costs. All right, now what we've all been waiting for. What are the landlord-tenant laws like in Tulsa, Oklahoma? Well, the good news is there is no rent control within the state of Oklahoma itself. For evictions, if you're looking to do a no-fault eviction, you only need to provide a 30-day notice. For evictions where someone is violating the lease or refusing to pay, it's a 5-day notice. There's no statutory limit on security deposits. And there are no tenant boards of any kind. Tulsa is a landlord-friendly metro. A couple of highlights from Tulsa. One is a park that they have called the Gathering Place, and it's almost like a Balboa Park. And this place was amazing. They had all these meeting spaces. They had places for the kids to go into these incredibly built playground areas. I mean, it was really just, it was a local park. Well done. In fact, it's earned the USA Today Best City Park of 2024. Like any market, Tulsa has its challenges. One thing I noticed was an incredible amount of graffiti. And if anybody knows me, I hate graffiti. And Tulsa was covered in it. I'm not sure what's going on there, but certainly the city leaders have to get a hold of that problem. Maybe eradicate graffiti by banning spray paint. I'm not sure what the answer is. Personally, again, I hate graffiti like many of you. Super surprised at how much graffiti was sprayed around Tulsa. The other thing I noticed was a high level of homelessness. Definitely two areas where the city leaders need to get a handle on things. But at the end of the day, if you're looking for a market to relocate your equity into, Tulsa is a good option considering they have an incredibly low unemployment rate. They have a lot of businesses moving into the area, and rents still have some room for growth. Definitely have their challenges like every other metro area, but certainly worth a deeper look if you're willing to relocate your equity. That's my rental market update for Tulsa, Oklahoma. I'm Doug Tabor, helping you turn the terrible T's of rental properties into more time, travel, and tranquility. We'll see you next time.